But what I can say is if you're an investor, you kind of got to have a 40-year time horizon or longer. And if you're a saver, you're a 10-year time horizon or longer.
Welcome to Dream Richer. The Feds have lost all control of the economy. In the words of Michael Saylor, we are seeing an economic breakdown. As he argues, the Feds need to set a fair rate and get out of the way. Inflation is at a 40-year high and still accelerating. The Fed's inflation fighting credibility is damaged, and it has lost control of the monetary policy narrative. The Federal Reserve, like other central banks, was established to foster economic prosperity and social welfare. One of the missions given by the Congress to the Federal Reserve is to keep prices stable and keep them from rising or falling too quickly. That, however, now seems nothing more than a fantasy dream. In fact, the food index increased 0.9% in April compared with March, which is the 17th consecutive monthly increase. To much surprise, Mr. Joe Biden's top priority right now is to fix the economy. This is what he had to say. Inflation is a challenge for families across the country, and bringing it down is my top economic priority. These words are also showing no sign of holding up to their promise. For example, the costs of shelter, food, airfare, and new vehicles were the largest contributors to April inflation, which are basic necessities for all human survival. By the end of this video, Mr. Saylor unravels the mystery of our current economic situation. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
If I go back to January, and I just picked like January 1st, 2020, while we were still innocent and before COVID hit and then the war on currency hit, etc. And then you go forward to today, and I look at what happened. Well, the money supply, the M2 money supply of the US dollar expanded, by my chart, 41%. We expanded the money supply about 41%. Now, how did all the assets behave? Well, gold is up 20% since that day. So the gold captured half the money supply expansion. It didn't track the money supply. What did track the money supply? US single-family homes up 46%. You know, we all know the story of home prices exploding. So single-family homes slightly outpaced that money supply. You would have beat the money supply slightly with desirable real estate. You would have beat it with commodities. You beat it with Bitcoin, which is like a basically synthetic digital commodity, but it's scarcity. You wouldn't beat it with gold. You wouldn't beat it with NASDAQ stocks. You wouldn't beat it with the S&P index. And so, you know, you could roll the clock forward. You can roll it to August 10th, 2020. That's the date that my company bought $250 million worth of Bitcoin. And so people knew who I was on that date, and we made a macroeconomic commitment. Now, we've been studying it for 90 days previous, and so we made a commitment based upon the circumstances in the second quarter. If you look at the macro numbers from August 10th, if we had bet $250 million on gold, it would have been down 10%. Gold is down 10% since August 10th, 2010. So gold got a boost in the first part of the crisis, but then it kind of flagged. NASDAQ is like flat, minus 1%, 0%, went nowhere for the entire 18 months. The S&P slightly up, 11%. Single family homes up 26%. The money supply up about 20%, maybe 25%, depending on how you count it. So again, single family homes tracking the money supply. Bitcoin, even as it's been thrashed right and left, up 86%.
If inflation reduces the value of money in your pocket, there needs to be something to fight back. Raising interest rates has just that effect. Think of it as a seesaw. If inflation gets too high, interest rates can pull it back down. Let's say you lend your mate $100 with an interest rate of 5%. You'll get $105 back when he pays up. But if the interest rate is higher, say 10%, you'll get $110. In other words, your money is worth more. So that's why central banks increase rates to control inflation. However, this move also has a couple of bad effects on the economy and the markets. For example, when the interest rate rises, your bank increases the rate on your credit card and your mortgage. This means you have less money to spend. Also, banks don't just raise rates to you. They raise them to companies as well, which can leave many in debt by millions or even bankrupt.
So macroeconomically, if you're looking for any good idea with a time horizon of less than 2 or 3 years, even 4 years, you're just a trader. I think there's something wrong. There's a moral hazard to making 99% of the population traders, right? The real moral hazard of the government monetary policy is by pegging the interest rates to zero and by yield curve control, they've demonetized the currency, or they've eliminated the currency as a store of value for savers. And that means they've forced retirees, it doesn't matter retirees, it doesn't matter whether you're 20, 30, 40, 50, 60, or 70. They were forced non-financial investment professionals to take risk. The combination of low interest rates, which have kind of demonetized the sovereign debt, and then the excessive intervention means that free market scrambling to monetize something else. We're monetizing Rolex watches and luxury cars, and we're monetizing investment properties, and we monetize meme stocks, and we monetized random crypto, assets and the like. And the problem with having 100 forms of money or 1,000 forms of money is this cross-border problem, right? Like, do you really want to pay for your milkshake with Shibcoin, right? Or with your investment property on the lake or something? Not really. It's very inefficient when you have a breakdown of the money system. And the other problem with it is that it kind of puts the Fed and puts the central bankers in control of the pricing of every asset, right? What you really want is for them to just set a fair rate and get out of the way.
It's clear from Michael Saylor's explanation that inflation is truly upon us. It's only a matter of time before we see extreme actions that must be taken to bring the economy back to healthy levels. As Mr. Saylor argues, the increase in prices can cause a domino effect that brings entire economies into recession. It doesn't just affect us mere mortals when we buy pizza and Freddo chocolate and train tickets, but it also harms the companies listed on the stock exchange and their shareholders too. Hence, everyone needs to be invested into assets that will hedge them from the coming inflation. Some ways you can achieve this is by investing in treasury inflation-protected securities, short-term bonds, stocks, and gold. However, the best options, according to Michael Saylor, are real estate and crypto, in particular, Bitcoin. To learn more about the latest crypto news, watch these videos here.